The blockchain now allows stakes in virtually any asset to be sold as a token, but is that risky? This is Inside ETFs, and we're talking about the blockchain. A blockchain is a decentralized digital ledger that stores information in a peer-to-peer network of computers rather than in a central authority. The first decentralized blockchain was built to host Bitcoin, but money managers are now using them to offer tokens based on real-world assets, from publicly traded shares to stakes in privately held companies. Christian Magoon is CEO of Amplify ETFs. Christian, the blockchain has gone far beyond cryptocurrencies, but why use it to issue tokens based on other assets?
Well, Elena, blockchain is really kind of the updated technology for kind of this digital future of financial markets. So blockchain offers more speedy transactions as well as lower cost transactions. So unlike maybe a T+1 settlement of a stock trade, trades on the blockchain could be settled in seconds and for pennies on the dollar. So the efficiency there, I think, is the main aspect. There's also an element of trust, because when you own something on the blockchain, it gets verified on the blockchain, and that's immutable. So there is that aspect in this digital economy where it's hard to often trust online transactions. The blockchain stands behind it and offers a good record-keeping version of that transaction.
You have a blockchain ETF, Block. I think the largest single holding is the trading platform Robinhood. It's a pioneer in issuing tokens tied to stakes in private companies like OpenAI, although OpenAI said it doesn't endorse selling those tokens and they're not OpenAI equity. Isn't this a risky strategy?
Well, it's definitely a different approach. So it's true that this tokenization of equities, at least private companies, by Robinhood is synthetic. So it's something they're offering, and you're kind of almost taking a credit risk that Robinhood is going to be able to produce the returns through their blockchain. I think that this will ultimately be something that will be of value, but it is a heightened risk versus buying, for example, a 40 Act regulated ETF that would own publicly traded shares. So kind of the risk reward is you may get access to the returns of these private companies backed by Robinhood. But the risk is, if there's something that happens to Robinhood, you're kind of subject to the risks of their balance sheet, that they will be able to produce these returns. So something investors need to be aware of for sure.
Do you think, though, that retail investors excited by the idea of exposure to a hyped private company like OpenAI or SpaceX really understand the risks in tokenization?
Well, they probably don't, to be honest. We're in the 40 Act investment space offering ETFs and feel like that's the most superior vehicle for risk control. However, there's a lot of innovation happening in tokenization, not only with Robinhood, but now BlackRock is talking about tokenizing equities here in the US, as well as ETFs. The NASDAQ has filed for the tokenization of stocks trading on their platform. So I think it's coming. Robinhood's probably on the bleeding edge here. And for most investors, they're probably better off still focusing on the publicly traded securities market and the natural guardrails that are there.
Now, some of those companies, including some in your ETF, support stablecoins, which are pegged at 1-to-1 with the US dollar. Was the recent change in the law in the US to give them a regulatory framework a game changer?
I really do think it's a game changer. To be able to have US Treasuries backing stablecoins on a 1-to-1 basis is great for the US government. It gives them kind of supremacy for US Treasuries and the US dollar being part of this next kind of digital world of payments, of stablecoins, of tokenization. So that's good for the US. On the other side, for consumers, stablecoin technology is much quicker, much less expensive than ACH, money transfers, wire transfers, even the SWIFT system. So that'll introduce efficiencies that we don't have today. So it's a big deal, and we think that the underlying companies that are embracing stablecoins, as well as tokenization, as well as the underlying cryptocurrencies that these are being built on, Ethereum, Solana, etc., are going to have some major price appreciation opportunities over the next few years as adoption really increases.
Are you confident, though, that stablecoin issuers have sufficient reserves to withstand a surge in drawdowns if there were one?
Well, I'm not. I do think that US-based stablecoin issuers, I am confident, because they will be having to comply with the Genius Act. There are other stablecoin issuers outside the US that I'd be careful on. So the key here, to your point, is that you really don't want to buy a stablecoin that doesn't have a one-for-one issuance policy with U.S. Treasuries or the U.S. dollar backing their stablecoin. There's a lot of stablecoin assets that are linked to Treasuries. We're getting close to $200 billion of Treasuries owned by stablecoins, so it's a growing owner. But you have to really do your homework to make sure if you're using stablecoins that they do have the assets and they're backed by U.S. Treasuries. I would focus on companies that are based here in the U.S. more so than outside.
That was Christian Magoon of Amplify ETFs. Don't forget, you can watch more videos on Reuters.com.